This past week was a really big week for the market. We saw the reverse repo facility fall to $33 billion. This is the lowest it's been now since 2021. And basically, we can say that all the excess liquidity that's been floating around in the markets is now effectively gone. And we need to remember that this is important and it comes at a crucial time. This is at a time where, Treasury issuance is going to ramp up because we passed the big, beautiful bill. Debt ceiling has been raised. Treasury now can refill the Treasury General Account. That means that the Treasury General Account, which is currently sitting at around $504 billion or so, is going to be able to rise back to this $850 billion level. And that means that we're now at a point where the falling reverse repo facility will no longer act as sort of a offset to a rising TGA. And so when we think about all of this, we have we have reserve balances, and that's this green line up here. And so one of the reasons why we've seen the reserve balances come down and then pretty much go flat for the last call it 4 years is because you had this reverse repo facility rising. You notice that as the reverse repo facility was rising, we saw reserve balances coming down. You can see there were certainly periods of lots of fluctuations in the TGA. These were all due to debt ceiling issues in the past. And so as we see the TGA now refilled and without the reverse repo facility to offset it, you're going to begin to start seeing these reserve balances come back down towards this lower region, somewhere around the $3 trillion mark, potentially even lower as we go into periods like month end or quarter end. And so the way this really works is that, if this is the Fed's total balance sheet, where it peaked at close to $9 trillion, and the reverse repo facility is a liability on the Fed balance sheet. As it rises, it pushes down reserve balances, and as it falls, it pushes up reserve balances. But in the meantime, the size of the balance sheet was consistently shrinking because we had quantitative tightening going on. And so the effects of quantitative tightening were never really felt because you had the reverse repo facility draining, essentially adding back into the system $2 trillion into reserve balances. And so essentially what you got was a draining of the reverse repo facility, which helped to offset quantitative tightening. And that left reserve balances fairly steady for nearly 4 years. But again, as I noted, we're now at a point where there's no more offset. Quantitative tightening is still going on. And the TGA, every time it rises and falls in value, adds and subtracts from reserve balances. And so at this point, we're no longer going to have any of those real offsets in place. And so when the TGA rises back to $850 billion, we're going to see this come out of reserve balances and head, like I said, to that $3 trillion mark. In the meantime, you're still going to have quantitative tightening going at around $40 billion a month. And while that's a much slower pace than what we've seen here, you're not going to have this buffer anymore to support reserve balances. And reserve balances can really begin to move more down, and really we can start feeling the effects more meaningfully of quantitative tightening. And so this week is really going to be that week where we can begin to see those effects. One way that we can keep a tab on whether or not there are funding strains developing in the overnight markets is by really keeping an eye on SOFR, and we'll have to continue to monitor this over the next couple of weeks to see if there's a little bit of an uptick. This number comes out every morning at 8 a.m., so it's easy enough to keep track of. And if we start seeing a tick higher towards 440, even closer to this 450 level, if that should happen for some reason, that's really an indication that reserve balance is dropping or starting to have a little bit of a strain on the funding market. When you think about the stock market, at least, for a good time, it's really been it's really tracked reserve balances fairly closely. In fact, if you go back and you look, you can see that, the market, when reserve balance is basically flattened out in 2014, you really saw the S&P 500 flatten out. When there was some volatility in that market, or as it started to drain, you saw the effects of it hitting, creating the volatility that we saw in 2015 and 2016. During the period where they were fairly stable, you actually saw the market rally, and sort of the effects of the drain weren't really felt, I think mostly because the reserves were fairly stable. But once we started to see reserves declining again, you can see the market volatility really started picking up until we started to see reserve balances rising. And then once reserve balances started to rise, you can see we started to get the market going up. When reserves came down, market came down. As reserves started to recover in 2023, because we were starting to get that offset of the reverse repo facility draining, which we can highlight right here. As the reverse repo facility was draining and reserve balances were stabilizing, you were able to see the market really rally. And so now we're at another point here where we're likely going to start seeing these reserves coming down. The only question, of course, is how far do they come down? And the other question, of course, is, what kind of effect, if at all, will it have on the stock market? I mean, history would suggest that at the very least, if reserves do start coming down in a more meaningful way, that we would expect to at least see increased levels of volatility. I would expect that we see something similar to what we saw in 2018, first 3 quarters of 2019, and potentially more of what we saw, here in 2015 and 2016. And so again, it doesn't necessarily mean market has to go down and stay down, but what it could mean is that we're going to start seeing a lot more volatility, a lot bigger swings in the marketplace, because liquidity is just not going to be as stable and as predictable as what it has been in the past. We're just going to have to continue to watch this fairly closely to see how things develop. I mean, you can certainly see, even when you go back to these periods in time here, big spikes in the reverse repo facility led to pretty big drawdowns in the equity market. So this isn't something that's new. It's actually been something that's been taking place for a really long time. It's just become a much bigger, more well-known development today than what it had been in the past. And obviously the size of the Fed's balance sheet has certainly brought a lot more attention to it. So I think at this point, we're just kind of keep watching where these balances are on reserves coming down. And so I think by watching things like SOFR, it's going to give you a little bit of a heads up if there is starting to be a little bit of pressure due to the fact that we are seeing reserve balances dropping. Anyway, I hope you found this helpful. Please remember to subscribe to this channel, like this video, and share it with your friends. See you later. Bye.